Guys, so for my third video, I'm going to talk about 1031 exchange. Um, so when you buy an investment property and you sell it, any profit that you make on the property, you have to pay capital gains tax on. Usually that's about 15% if you're married and filing jointly and you make less than 600K a year. Um, However, the IRS has a section in their tax code called 1031 that allows you to defer capital gains tax if you use the proceeds from your first property and you invest it into a second property. And you can 1031 exchange a property as many times as you want. However, you must engage with a 1031 facilitator before you close from the sale of your property. And the 1031 facilitator actually holds on to any proceeds from your sale. And then when you go and purchase the second property, the 1031 exchange will transfer the funds on your behalf. A few rules on the 1031 exchange. You have to identify 3 properties within 45 days of selling your property, and you must close on one of those 3 properties within 180 days. There is another method called the reverse 1031, which allows you to purchase a property before you sell your first property. And in a reverse 1031, you have to have the cash and the capital to be able to purchase a second property. And then within 45 days, you have to identify which of your investment property you want to sell. And within 180 days, you must sell one of those properties. The thing with the reverse 1031 is it's a little bit more complicated because you cannot own 2 properties at the same time that you're going to 1031 into each other. So the 1031 facilitator have to be actually the one that holds title to the property while you're selling your investment property. So it costs a little bit more, but it gives you more flexibility to identify and purchase your second investment property. The most important thing about 1031 is the intent. When you are selling your first property and you purchase your second investment property, the intent must be to hold it for long term, and that generally means holding it for 2 years. And that's why fix and flippers do not qualify for 1031 because their intent is to buy, fix it up, and sell it within a short period of time. Now, why do people do 1031 exchange? Because you are delaying the payment of capital gains tax. So in a scenario where you're selling a $2 million property and you have $1 million of capital gains, you don't have to pay 15% of that. So 150K of that, you don't have to pay it right now. You're investing that into your next property. So the base upon which you grow the equity on your next property is bigger. You can 1031 it into as many property as you want or as many times as you want. And here's the cool thing about 1031 exchange is that let's say you've 1031 exchange multiple times. You've turned a property from $1 million into one $10 million property. When you die, your heir will inherit the property, but they will not inherit any of the capital gains tax that you deferred. So they actually get a step-up basis. Let's say you have a property worth $10 million when you die. Your heirs will get a step-up basis. So their cost basis is not what you purchased the property for. Their cost basis is the market value of the property at the time that they inherit your property, and they do all of the capital gains that you deferred, it gets wiped out. So your heirs do not have to pay any of the capital gains tax that you've deferred over life. So instead of selling a property, paying 15% capital gains tax on millions of dollars, and then transferring that cash to your heirs, you could just have your heirs inherit a property and then pay no capital gains tax. So, I am going to share my screen here, and we're going to look over the math of 1031 exchange. So, okay, so here for your first property, you've purchased it for 500K. And for simplicity's sake, I'm just going to use full numbers. Your cost basis for this property is 500K. There's actually a lot more that goes into cost basis. You have to, if you remodel the property and do any repairs, you can deduct that expense against the cost basis. And if you sold it for $1 million, your profit is 500K. If you do not do a 1031 exchange, you have to pay a capital gains tax of 15% on the 500K. So you have to pay about 75K of capital gains tax. Now, let's say you purchased the first property with a loan. So you only made a 20% down payment. Your initial investment is 100K. When you sold your property for $1 million, you have to pay back the loan. So your cash proceeds is 650K. And obviously, this is a very simplified calculation because you also have to pay commission, closing costs, excise tax. So it's just a way simplified calculation of what your cash proceeds is. Now, and this also shows kind of an example of the appreciation, the leverage appreciation that you could get from a real estate investment, because even though the property has gained, has doubled in price, your initial investment of 100K turned into a cash proceed of 600K. That's almost 6x in return on your investments. And you're thinking doubling in price is, very rare, but actually, if we go into the historical real estate prices data for Seattle, 10 years ago in 2025, the average price of a real estate property for property in Seattle is 550K. But now, in 10 years, the average price of a property is $1 million. So doubling the price for a property is not unheard of. Now, let's say that you're able to take your cash proceeds, put it into it as a down payment to the next property. You're able to purchase a $2.6 million property because 25% down payment is $2.6 million. Your cost basis on this property is $2.1 million. How the IRS calculates that is they take your purchase price minus the original cost basis. So, and then let's say in 5 to 10 years, you sell it for 3.9 million. I just did a rough calculation of what happens if it gains 50% in price. Your profit is 1.8 million. If you sell at this point, you would have to pay a 15% capital gains tax of 270K. But the cool thing is, your down payment was 650K. You sold it for 3.9 million. You took out a loan for 75% of the purchase price. Your cash proceeds this time is 1.9 million. And all of this cash proceeds really came from your one down payment of 100K. So, now I won't go into a property 3 scenario, but let's say that now you're by property 2, you die, and your heir would get a step up cost basis. So right before you sell, let's say your property is worth 3.9 million. Your heirs cost basis is the market value of the property. So it's actually 3.9 million. And then when they sell, they essentially pay no capital gains tax on this property. And all capital gains tax that you've deferred so far from all previous 1031 exchanges are wiped out. So this really benefits any lifetime real estate. So this is really beneficial if you want to transfer any generational wealth onto your heirs. So that's kind of really the basics of a 1031 exchange. And let me know if you have any questions or if I got anything wrong.